Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's Tuesday, December 30th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. Merry Christmas. And in 2 days, Happy New Year. I wanted to focus on that word happy for a second. Okay, here comes another rant. It's the end of the year. Let's have some fun. Read a few interesting stats. According to a poll taken by the Washington Post and ABC, 71% of Americans have a negative view on the U.S. economy. According to CNN, 60% of Americans believe the American dream is out of reach. I don't know how they define the American dream. I mean, is that being as wealthy as Warren Buffett, Bill Gates, or is it, having a home, a great family, and a decent job? They didn't really define it. The last stat came out a couple days ago, according to a recent Associated Press poll. Nearly 60% of Americans describe the U.S. economy as poor. Now, guys, in the next 10 minutes, I'm going to give you a few stats. While I'm giving you these stats, I was thinking about playing the song Happy by Pharrell, because I'm always a happy guy. I'm a nice guy. However, most people are ticked off. They think the U.S. economy is horrible. It's terrible. And after I'm done reading you these stats, send me your thoughts on how you believe the economy is. Curzio1@gmail.com. Again, listen to this part first before you send me the email. Not sugarcoating anything. Just facts I'm going to give you. Don't worry, I'm not going to play that song. It's annoying, even though I am a happy guy. I won't play that song, I promise. But here we go. In 2014, we had near record car sales. In fact, the U.S. auto industry generated a record $1.1 trillion in sales this year. And for those who believe, they're giving credit out to anybody, there's an auto loan crisis on the way. It's going to play out like the 2008 housing crisis. Guys, that sells. That's a great story. It's really cool. But it's not true. The auto loan delinquency rate is 0.95%. Well below historical average. If it goes at 3, 4, 5%, then I'll worry. It's below 1%, the auto loan delinquency rate. To put that in perspective, student loan debt, that's at 14%, the loan delinquency rate. The auto loan rate on record sales of $1.1 trillion, less than 1%. Last quarter, the U.S. economy grew 5%. 5%. The quarter before, it grew 4.6%. Most people think the U.S. economy is terrible. They're not happy. The unemployment rate is under 6% for the first time in 6 years. We created, on average, every month, 240,000 jobs. Every single month, on average, in 2014. I know the haters are going to come out, blame the labor participation rate, and I talked about this before. How many people are discouraged that they've got unemployment? How many years have they got unemployment for? I don't know what it is now. I know they were getting unemployment for 2 years, sitting in their house and going golfing and stuff. I don't know how long it is now to find a job. I think you can send it to pretty close to a year. I'm pretty sure. You guys can email me the stats. But that's the case for the labor participation rate, that so many people are so discouraged that after a year they can't find a job, so they don't even look anymore. That unemployment rate is 100% wrong, which is totally false. If you look at the stats behind the labor participation rate, totally false. Totally false. More people today are retiring. More people are on disability than any time in our history. It's insane when you do the research and look at the numbers. Again, you want to go back to my podcast? I already looked at those numbers. Maybe I should have went on disability after my second back surgery, joined the crowd, but I didn't. I like to work. And I have to hang out with my wife and kids every single day. Not a terrible thing. Having a 4 and 6 year old, 3 girls, not every day. That's a little hard. Anyway. Looking at a labor participation rate, it's just not an indication of people that have stopped looking for jobs. And you go back and look at the statistics. Since 1950, men in particular, have been dropping off the workforce. And these declines accelerated at almost the exact time baby boomers began turning 60. Now, baby boomers are defined as people born between like a 20-year period, mid-1940s and mid-1960s. As more people retire, less people are going to be in the workforce. But they want to, zero hedge every single day. Zero hedge for the past 5 years. And I like them. I like zero hedge. They have a lot of good stories. They do. I'm not picking on them. But if I had to guess how many positive stories they printed on the U.S. economy, I'd probably say less than 0.001% out of their, 10,000 stories in the last 5 years. Markets at all-time high. We're growing at 5%. Everything's negative. Nobody's happy. Oil prices crashed from over $100 a barrel to what? $55, $60 a barrel today? 50% decline? Gasoline prices down 28% from last year, lowest level in 6 years. And the drop in energy prices is equivalent to a $60 billion tax cut. That's what economists are putting, a $60 billion tax cut because of the drop in energy prices. A lot of extra money in people's pockets, but they're still not happy, right? Nearly 60% of Americans think the economy's terrible. We're not happy with it. Manufacturing strong. Almost everyone, and I'm telling you, almost everyone that has a job in manufacturing that emails me. These are hundreds of people in different fields. Tells me how busy they are throughout this year and last year. And if you're in that field and you're not busy, send me an email, kersey01@gmail.com. I'm not sugarcoating things. I'm just telling you what I hear. This is why I love this podcast, that it goes out to tens of thousands of people. Because I get emails from people in every industry, and they're not sugarcoating. They're just saying, Frank, you know what? I work, whatever industry it is in the manufacturing sector. Never been this busy before. It's crazy. A couple months ago, the summer was a little slower. Now, forget it. It's so busy. You have no idea. It's crazy now. We're hiring. I hear that from so many people. Again, let me hear from you if I'm wrong. I'm just telling you what I hear. Retail sales, solid. Industrial output, which means it measures the output of factories and utilities. It's surged to end the year in 2014. People are still unhappy. Wages are rising. 20 states will raise their minimum wage starting in a few days, January 2015. So more money for people again. And the stock market, haven't even got to that yet. The S&P 500 gained 33% in 2013. Another 12.6% in 2014. It's at an all-time high. Almost everything is near an all-time high. The NASDAQ is 5% away from its all-time high. Remember tech, 1999, 2000, a peak? 5% away. Russell's, S&P, Dow, all-time highs. And how many people have you listened to on CNBC and Fox Business or wherever since 2010 that told us stocks were going to crash? How many people? Think about it. Because I can name 50, which I won't. I could probably name all 50 right now, but I won't. That even if we pull back 40% next year, these so-called gurus would still be wrong on their initial forecasts. And I'm not picking on them. I'm really not. I'm not picking on them. I'm just saying, how aren't those 50 people that I can name happy? Are they pissed because they got their forecast wrong? But how are these people complaining that the economy's, almost 60% of Americans believe the economy's bad? If you're one of those people, Americans, who view the economy as poor right now, you should jump off a bridge. I mean, it's not going to get better than this. It's not. It's not going to get better than this. I've been in this market for how long? Of course, don't jump off a bridge, please. I'm kidding. I'm trying to drive my point home here. But think about that for a minute. I mean, it was a fantastic year, and I'm not saying the Fed is not manipulating the markets. Keeping interest rates at zero while the economy is growing, 4.5% on average past 2 quarters? Bailed out the banks. Their balance sheets are stronger than ever. They could pay out these fines of 10, 20 billion like they have the money in their back pocket, and their stock price doesn't even blink. It goes up on these announcements. So I'm not saying that. I'm not painting a perfect picture for you. I'm not saying that the market can't fall 15 to 20% next year after having back-to-back great years. I'm not telling you that I'm not scared about the enormous amount of debt our government has accumulated over the past 5 years to bail out so many people and so many companies that did the wrong thing. And that could impact my kids in the future. I am not saying that. All I'm saying is you can't be pissed off that the U.S. economy is terrible today. That stat makes absolutely no sense. 60% of Americans. And even the 60%, if you go, how many people on food stamps are paying taxes? And these people are getting checks every day. How could you be unhappy? How are you unhappy? You should be the happiest. I mean, you're getting paid for not even working for years. You should be the happiest people out there. So I don't even know where this figure comes from, how they calculate it. I really don't. But if you think America is terrible, just look at the rest of the world. Pick any country in Europe, almost any country in Asia, South America. And imagine this, you're on vacation, and say you just happen to go to a place like Venezuela, Mexico, Russia, Greece. You're at a local shop, you're drinking coffee with some of the locals, and you say to these people, man, America's terrible right now. Our economy really sucks. Automatically, you're going to get punched in the face. I guarantee it. I guarantee it. If you go to those countries and say, America's terrible, it's horrible, the economy's terrible. Imagine what they would say to you any place else if you said that. So again, I don't know how these polls are conducted. How do almost 60% of Americans think our economy is terrible today, right now? Low energy prices, record highs on stocks. Things are cool. Things are fine. So if you think it's terrible today, just look out. Because I'm telling you, even being part of this market, you talk to people who are 60, 70 years old, who live through ups and downs, have 40 years experience even in the market and stuff like that. They'll tell you, you should be really happy right now. Things are good because I've lived when things were really, really bad. I'm not talking about 2008, even other times. But you talk to those people, I guarantee you they're not the ones that are saying America's terrible right now. It's the younger generation, the privilege that we just give things to. But I just couldn't believe that number. I'm like, really, if you're unhappy now, as a person who visits like the entire world to try to get you stock stories and just sees, what's out there in China and, poor cities in China, these people are so happy and they have nothing. I mean, how much are they making there on average? We make what, like $52,000 on average a person? What are they making, like less than 10? They're happy. We're not. Really? Just unbelievable stat. Unbelievable stat. And it's coming out from so many different polls too. It's not just one crazy poll. So you know what? Be happy. Stop complaining. Or stop listening to the politicians and media outlets, the blogs who point out all the negative news. Because you know what, guys? You should know this by now. That's what sells. No one wants to say, wow, everybody should be happy. No, everyone's going to point to what's wrong, what's horrible today. It's a reason why I do this podcast, why I love doing it. I like telling you the real story on what's going on. That's how you make money. I'm not a perma bull, not a perma bear. Tell how it is. Bring on all kinds of guests, even some who have different opinions than myself, so you could decide after listening, researching, analyzing all the data, what's the best decision for you and your family. I'm glad most of you have been fully invested in this market over the past few years. A lot of my guests have come on and said, listen, the market looks attractive here. Most of them. They've done a good job. I'm not even talking about myself or my predictions or anything, but even some of the guests that I have on. I'm just happy that, if you've been listening to this podcast, you're invested in stocks. You're doing pretty good. You haven't listened to all the noise, how the world's going to end. Go buy a cave. But really, 60% of Americans think the economy is bad today. Amazing, amazing stat. Anyway, Happy New Year, everyone. Let's start out with that rant. I have a special guest for you today. His name is Pham, who's a hedge fund manager who lives in China. And he's brilliant. Just started a new podcast, reached out to me. He's going to tell you why technical analysis is archaic. Yes, I'm ready for the emails from all the tech analysts that listen to this podcast. But hear him out first. Not saying that I agree or disagree, but hear him out. Going to break down his methodology for picking stocks, which is kind of simple, and his returns are unbelievable. Now, keep in mind, Peter's a hedge fund manager. He's going to share some of his positions with us today, which is really cool. And hedge funds are highly regulated or becoming highly regulated. Ever since the Rajanathan trial for insider trading, I mean, these guys, it's even hard for me for them to talk on the phone. They shut down all instant messages services, just anything and they're not doing anything illegal. It's just anything can be construed as something else in today, in social media. I mean, you can't even send an email. Look what happened to the Sony executives and those emails with Angelina Jolie and everybody else. Are you kidding me? That goes on in every business. There's emails going on. Oh, this person's this or that or this. This is what we need to do. Imagine if you could read everybody's emails, like in a business. That'd be great. You know how much everybody got paid? That's insane. You know how many pissed off people there'll be? But anyway, ever since that happened in the hedge fund industry, it's been hush hush. And Peter's coming on. He's giving you a lot of information, talking about his methodology. And he's also, more important, going to share some of his picks, which I really appreciated. And then I try to explain everything this way you can understand how he picks stocks and how his performance is so great. So it's going to be a really, really good interview, which we will get into right now. We're talking to Peter Pham, global hedge fund manager, author, libertarian, based out of Asia, and also now a podcast host, which is how we met. Peter, thanks so much for being on the podcast.
Thanks, Frank. It's great to finally be on your show and make it in the big times.
Yeah, okay. Well, Peter, listen, when I always look up hedge fund managers and even their web pages, usually I'm able to not hedge fund manager. When I interview people, I try to do as much research as possible. And being a hedge fund manager, all hedge fund managers don't have a lot of info on them. So I'm probably doing a terrible job describing you. So I wanted you to go into a little bit more to talk about yourself. Something I never really asked, but being that you're a hedge fund manager, it's not easy to find information. I know a lot more about you. Why don't you explain and give the audience a little bit more about yourself?
Yeah. I guess I became a hedge fund manager strictly just out of, the passion of wanting to understand about investing. I kind of started off in Canada, where capital markets are less embraced actually than in the United States. But, experiencing the .com collapse and trying to understand what happened to all my capital as it got eroded by speculating in .coms, and then experience everything that happened in about 2007, you start to really sit down and wonder to yourself, like, what's going on, right? When you're watching things on the news and you're hearing about the 99% and the 1%, what's happening here? And taking an analytical approach to this is how can, the average Joe basically start to replicate what the 1% is doing in a very fair manner, and what can we learn about markets and how can we benefit off of that? So I think it was during like the early 2000s when you start to see the rise of the price of crude oil and all the commodities. So when you're going to the gas station and you're trying to, fill up your gas tank and you're seeing the prices just continuously skyrocket, what can you do as a average Joe, a retail investor? Well, what you can do is buy income trusts to derive some income off of that in order for you to be able to, hedge or mitigate the costs, the inflationary pressures that you experience in your day-to-day life, rather than just sitting there and complain about it. So, my story is basically spending the better parts of the last 15 years trying to understand capital markets from a very pragmatic standpoint, reading every single book, listening to every single podcast, every single audio book, to try to be able to come up with some certain truths about the market and try to minimize your emotional thoughts or your political thoughts or your religious thoughts about markets. So even there's a lot of people, that will be talking about social issues and how, Wall Street is a byproduct of many of these issues. But I think it's more about taking a look at markets, what we can do to exploit them to generate as much gains that we'd like to make, in order to have a much more, fulfilling lifestyle. So So that's my story. And I was been fortunate enough to be able to manage a hedge fund, to publish a book recently, to be able just to talk to the thought leaders like you guys, and bring that to the audience, primarily in places like Canada and Asia, and probably even just to provide an additional form of distribution for people in America to hear my perspective.
That's really what caught my attention too, is just that when we talked, I was just fascinated when we talked. And then when I started doing research on you, I'm like, okay, the hedge fund guy does have a lot of stuff out there. But when we talked off of this, I said, listen, you have to come on my podcast for several reasons, because the research that I've done with you and what I spoke to you about is, and most of the research that you do, you say it's fundamental analysis. But you also include the word quantitative when describing fundamental analysis. I want to go into your methodology, and keep in mind that we do have other hedge fund managers. We do have other bond managers. We have a lot of people that listen, but most of the people listen to this are your average investor, have other jobs, that are, who buy stocks, who are learning the market and stuff like that. But I want to go over your formula for investing, because you say a lot of things that are controversial and critical. But when I listen to you explain them, it makes a lot of sense. So let's start out with your methodology of what you do to pick stocks.
Sure. I think let's put ourselves in the shoes of a typical retail investor listening in right now, and think about what your ultimate objectives are. Right? Everyone has various different objectives, and everyone has different risk profiles of what they want to do. Now, a majority of investors, through the media and through, hearing various different news headlines about successful investors, often will use them as the various different gurus that they use to determine who they want to replicate. So typically you'll hear people say, hey, I want to replicate Warren Buffett. I really like his sound fundamentals towards investing. And look at him. He's effectively one of the richest people in the world. So clearly his methodology must work. That's typically how many people might approach that framework. The issue though, and you guys cover this quite extensively, is that the initial approach that Warren Buffett took to become the person that he became was actually to collect the various different fees and insurance premiums that allowed him to have a pool of capital for him to utilize. So when I manage a hedge fund, I don't have to use as much leverage as I like. But if I had a typical retail account making, the average median income in the United States, I'd have to utilize margin if I wanted to make these quote unquote fantastic gains. Or if I wanted to focus and devote all my time to focus on investing. So the number one component that you need to think about as an investor or a trader is that you got to think about what your ultimate objectives are and why you're doing what you're doing. If you want to become like Buffett, you must recognize that he basically bought a textile operating business, basically, minimize that operation as it was less profitable, focused on the insurance business, and tried to collect the premiums in order to create basically a fund for himself to manage. That was what he did. And he's been able to aggregate tons of capital and allocate that using less leverage and just letting time work in terms of the fundamental aspects of the companies that he's invested in, such as Coca-Cola and, all those other insurance companies that he's invested in as well. So if you want to do that approach, if you want to go through the approach of becoming, arguably one of the richest people in the world, you've got to take a look at a hybrid between fundamental investing, but also think about the structural business model that you're using to get to that route. Okay. So that's option number one. If you want to go the route where you're happy with making, average or above average or slightly below average returns, that are unleveraged based on the ideas that you like in terms of a particular stock, and you're not keen to be active about your investing, then that's fine too. But just recognize that that's a very different approach versus what Buffett did, which was to create a business out of his interest and passion for investing. So if you're interested in just buying stocks, for example, you're going to get, I guess, 15% this year, right? And last year you'll get the 30%. And if you're going to use a little bit more leverage than that, you put yourself in a position where you could potentially get a margin call. So then there's another approach where if you're more interested in understanding price, because suddenly if you have the portfolio, you're using a little bit of leverage and then you start being affected by the volatility within the market, then you become much more price conscious of what's happening. And the issue about that is then you start to lean towards various different forms of analysis with price, such as technical analysis. Now, just briefly speaking, without going too much into this, is that in science, for example, when you analyze something, you're using the scientific method, right? A method that actually argues that everyone can replicate it. So Frank, if you're sitting on another computer, you can replicate the same kind of analysis as I can. And that's what science argues for, where you're able to replicate a particular thesis or hypothesis. The issue with technical analysis, which is basically the understanding of price using quote unquote indicators and price patterns, is that it often is unreplicatable to the other person. And it's actually more about interpretation. So in psychology, there is a word called multi-stability, which means you're getting different conclusions. So if you're looking at like a head and shoulders pattern on your computer, Frank, I might be looking at the inverse of that. And that's a different conclusion. And that's because it's very artistic. It's like palm reading. It's like looking at the clouds and interpreting the pattern, right? That's one thing. Secondly is another phenomenon in psychology called reification, which is the interpretation of patterns, which I just spoke about, where, you might see something that I don't see, and I might see something else. And that's one of the issues about technical analysis, where it's difficult to replicate the studies. It's difficult to make it statistically significant or more of a science that you can replicate. So as you've seen throughout, society and with the innovation of technology, the phenomenon of big data and the analysis of data has become ever more critical. And you've also seen the emergence of what they call like algo traders, algorithmic traders within the market that are looking at various different nuances in price on a daily basis. So I think that by taking a look at some of those more recent trends, you can actually start to quantify, which is basically try to ascertain various different numbers and probabilities in terms of how you look at a particular price of a stock. So many people talk about market efficiencies and inefficiencies. Well, the number one market inefficiency that I understand about is that there is a 75% probability that the previous day's high or low will be broken on the S&P 500 or on any other stock or commodity that you can get the price of the high, low, close, and open of. That's the number one anomaly that I understand about the markets. And if you start to understand markets from the perspective of probabilities, you start to define your risk well. And this is actually communicated quite concisely in movies like The Moneyball, which was written by Michael Lewis. And he also, I think, recently published one about algo traders as well. So it's more about understanding probabilities. And I think a real life example of that is, imagine, if you will, you're on Times Square. And how often do you actually go into Starbucks? So say you go into Starbucks 8 out of those 10 times. The next time you're on Times Square, Frank, I know that there's an 80% probability that you're going to go onto Starbucks. And the same thing can be done in terms of price behavior and analysis. One other thing about price is that there's buyers and sellers. And a very simple phenomenon in the market is, if you understand market auctions, right? Any auction, if there are people that are willing to buy aggressively, that will have a big impact on price. So when you see lifting of offers, you know that the price of the stock is going to go up. When you see hitting of bids, you know that there's demand to sell the stock at market price. So when people talk about limit orders and market orders, you got to understand that the people that are willing to buy or sell aggressively on market orders at large volume are going to have a greater impact on price. So just to recap is that either you understand the business of it, of investing, which is to be like Buffett, have an insurance company or have a holdings company and start to build almost like an investing empire from that perspective. Great. Then there's number two, if you understand just more about the fundamentals, great companies that are demonstrating economic goodwill, then that's another approach. But be cognizant that you're going to be a victim of volatility. And if you're fine with that, that's great too. Then the third approach is that if you want to take a more proactive approach in understanding price and its effect to your investment thesis. So the book that I write about and the approach that I use on the fund is...
Go ahead and give the name of the book. Go ahead.
Oh, the book is called The Big Trade, Simple Strategies for Maximum Market Returns. And I literally mean that is that you're using a simple way to analyze something that is very much replicatable to generate the optimum returns. So it's all about the 80-20 rule, Frank, right? If you're just using 20% of your time, energy, and resources to analyze, a particular market or a particular stock, hopefully you're going to be able to generate significant gains and replicate that amount of research that a guy on the sell side sitting there on Wall Street is outputting to get and obtain the same results. So that's what I'm talking about.
Yeah. So you mentioned a lot there. I was going to stop you at a couple of points, but you had so many good points there because there's a lot to digest for individual investors. The first thing I want to talk about is the Warren Buffett methodology and how it became so rich. And I wrote about this too. Some people think they could buy Coca-Cola, hold it forever, McDonald's forever. Excuse me. And that's the reason why Warren Buffett was rich. But you brought up a good point on some technical terms where it says margin, leverage. People have to realize that Warren Buffett didn't become one of the wealthiest people in the world just by buying Coca-Cola. It started with insurance, which, I'm not going to say it's a scam industry, but it's one of the only industries that you put money up front, where if you buy a car, you get the car. You're basically paying your premiums or insurance in case something happens. So they have these massive pools of money. Now, say if you're Warren Buffett, who's considered one of the greatest investors, you're able to have all this money, and you're going to have to pay out your claims, which, they have all percentages, all models that you're going to make a fortune. A lot of these claims, whatever, there's not going to be that many, but they take that pool of money and you want to generate returns off of it. And you're looking at guys like David Einhorn, even Ackman, and David Einhorn has a vehicle called Greenlight Reinsurance. So basically they're taking for insurance companies, they're taking risks. So insurance companies are selling off some of that money to lower their risk. And Greenlight, which is David Einhorn, which is one of the best investors out there, right? Fantastic returns, he's buying this. It's reinsurance, and he's using that pool of money to invest in all of his ideas. So it's almost like starting your own hedge fund. What you need to do is raise money as quick as possible. In the insurance industry, it's the easiest way to raise money. And what guys like David Einhorn and Warren Buffett do is they take this money and they're able to generate huge returns on it because they're fantastic investors. And if you're interested in that David Einhorn, Greenlight Reinsurance, the symbol's GLRE, but it's just fascinating. I'm so glad you brought that point up because so many people say, I want to be like Warren Buffett. That was one point I wanted to make. I thought you explained that great. I just wanted to bring up that example. Another thing with your technical analysis is you use the word archaic, which may offend a lot of people, but you do bring up a lot of points, but you were also talking about certain things, 80-20 rule, and talking about things that sound like technical analysis to me, and maybe a lot of listeners out there where, some of the rules and some of the patterns and stuff like that. Could you explain a little bit more about that, where it seems like you're talking about technical analysis, but you're really not, are you?
Well, okay, technical analysis typically is you're using indicators to analyze price, right? You're opening a visual representation of the price chart, for example, and you're using indicators to analyze that. The issue, though, Frank, is that you have to understand, like, where do these indicators come from, basically? They're various different forms of interpretation of price, but in a laggy nature. And I think that's the most important thing is that if you're using like a stochastics, a MACD, any of those indicators, they're actually just lagging. They move after they see the changes in price to give you some kind of like conclusion, right? But it's a different conclusion for everyone else because if you change the time frames of the chart, then it becomes even more ambiguous. So the issue is that, like you just said, the word technical analysis is very deceptive because it sounds like it's technical, but the actuality is that, NASA would never ever use this approach when determining where they're going to land, how they're going to be able to, get a particular ship to open a various different door. We're talking about like, understanding the minute behavior and changes scientifically so that you can replicate whatever it is that you're trying to do, which is what technical analysis does not do. It actually just provides you a lagging interpretation of what you think you are seeing. And that's another important thing, is that it's about what you think you're seeing. Whereas what I argue for, Frank, is about looking at the numbers, looking at the open, high, low, and close, which is information that you can get anywhere, like on Yahoo Finance, and being able to understand how often is the high being surpassed by the previous high? How often is the low being surpassed by the previous low? Is there any kind of statistical significance there? What can we understand about this particular stock based on these behaviors? So what I've done is I've built a database that allows me to kind of look at stocks as if I was looking at like baseball cards or hockey cards, where every company, I understand about the behavior of the stock through probabilities. That is strictly an analysis of price, first and foremost. And then secondly, I'm able to look, when people look at those volume bars, the information that they're missing out on is how many of those people were buyers and how many of those people were sellers. Because you just see a total aggregate volume. You don't know, were these people buying aggressively or were they buying, as conservative limit orders? And it's until you can see all of that information that you're able then to make some pretty concise conclusions. And what makes it even more effective is if you have say you have a great understanding of a particular stock with its fundamentals and you merge the two together and you're willing to accept and say that, look, if my thesis for, Buffalo Wild Wings is not working because the price is not behaving in a particular way, and because there's an 80% chance that it's going to continue to go lower, then perhaps I need to sell. And that's one of the key issues that both retail investors and institutional investors have an issue of, is sometimes they become too married to a particular position. They become very dogmatic about what they're talking about. What's his name? Mark Faber. He's continuously bearish, even if equities are up 15% this year and we're up 30% last year. He'll continuously tell you that the markets are going down when clearly the markets are going up. So he's a perfect example of the bifurcation between price and valuation, right? He has his own interpretation, and many people argue that equities are relatively lofty, and that could be true. But as a analysis, I'm not here to judge about that because I'm trying to capture as much gain as possible. So I'm going to say, as long as price is continuing to go up and as long as the probabilities of me to continue to see these gains is happening, then I will stay on the bullish camp until I get indication otherwise. And whatever I believe about valuation can only be confirmed when price is confirming that to me.
Once again, I'm talking to Peter Pham. I want to talk about your 80-20 rule, because when I talked to you and I said, I want to put because there's a lot of terms out there, and I know people listen to this going, okay, I'm trying to write this down and understand it. But I said, if you could provide some examples, and you provided the easiest examples in the world. I said, what's going on in your portfolio? You said just two things. I'm long the S&P 500 and I'm long the dollar. And I looked at that and said, wow, here I am, or here a lot of people are watching TV going over oil. What's the price to, whatever the price to pull oil out of shale area? What companies are benefit? What are they hedged? What's this? What's that? And then going over, biotech, has it run its course and, doing all this stuff. And yet a simple strategy by owning the S&P 500 and going long the dollar, easily outperform the market. Explain that. Explain what's the reasons for you to just own those two positions. Because when people think hedge fund managers, they think of these exotic investments, real estate in, the middle of the Permian and buying distressed assets in Europe and stuff. And here you are with these two simple positions. It just caught me by surprise.
Yeah. The same, it happened when I was in Bay Street in Toronto, and I was speaking to this asset management company. They're like, what are you doing? And I said to them, yeah, I like the US dollar a lot. And then they said to me, is this not vanilla, right? Too vanilla for them, because they were looking at creating a more exotic portfolio. But I guess here's the 80-20, and here's all about minimalism as well as why make it so complicated, right? Just because it sounds simple doesn't mean that it is simple, right? There's interpretations to that. And what you're trying to do is you're trying to do something very complex, but also actually keep it very simple. So in terms of the US dollar, okay, we can talk about this position. We'll talk about some of the fundamentals. And then we can talk about just the analysis of price, which is confirming. Actually, let's get that out of the way. The US dollar has been going up for the last several months. And that's a confirmation of the thesis so far, right? Ditto for the S&P 500. Now, let's talk about the fundamentals about that, and let's talk about how that would look within a portfolio. Well, first and foremost is that many people try to go short, for example, throughout this whole bull market. And the issue is that when you go short, you're actually capping your upside through that short exposure. So one of the things that you can do is holding cash is a synthetic short because you're actually missing the gains that the equity markets are making. But the key question is, what currency in cash should you be holding? So if you can try to identify the best currency, the most optimal currency in a terrible block, because I know there's a lot of gold bugs here. So they might say, optimum, but optimum in a terrible block. Then you've created for yourself a very interesting position. You have your equity exposure long, but you also have the ability to utilize that cash for either more equity exposure or to benefit from the capital gain that the currency will give you. So that in itself is almost like what I call a synthetic short. It's the balance between the two asset classes effectively that give you the ability to capture as much gains as possible. Secondly is the S&P 500, which actually mitigates the volatility. Sometimes I know, Frank, you analyze stocks and your boots on the ground, but hypothetically a retail guy, unless he's reading one of your fantastic newsletters, might not be able to do that because his boots are in the office, for example, 9 to 5. So he wants to capture these fantastic gains. What if I told you would have made 45% just investing in the S&P 500? So that's very attractive. And how does he protect himself? Because he could be saying, oh, well, markets are going up and it's overvalued now. Well, he also then has exposure to a very strong currency, which is, in this case, the US dollar. Typically, currencies make up I forgot what the statistic was, about at least 30% of the capital gains that you're making. So what better is it than for you to have the S&P 500 denominated in US dollars and also having a big US dollar position? So that's more about the portfolio construction of all of this. If you want, we can talk about some of the structural underpinnings on why you want to have those positions.
Yeah, well, that was one of the things I was actually going to say, Peter, because we're running out of time here. But, you brought up a good point because I said, here you have these two simple positions. And I don't want, my audience and listeners to think, oh, it's simple position that you're like, the market's going to do good. And, let me just put in this portfolio and you're on the golf course. When we talked offline, you were talking about, the tons of research that you do when you broke down every currency and how the U.S. is the best currency, how every government is easing, and not just easing, how a lot of governments almost trumping their news, where as soon as you see Europe come out and ease it and you're seeing China, it's all happening within days or weeks apart. And then, you talk about the deflation of commodities, which is making it great for multinationals. There was a ton of analysis that went into buying this, but it just seems like, it's more of a simple strategy. And that statistic you brought about currency and that 30% was amazing. What's more amazing to me is when you look at the dollar here, and you look at the U.S., I guess I'm going to play Monday morning quarterback here. Why are so many people so short the dollar? Because when I look around the rest of the world, it just seems like we were doing so much better than everybody else. And I'm not saying things are great here, and everyone knows every statistic about the massive amount of debts, the bailouts. We understand that that's going to hit us maybe at a different time. But why are so many people out there just, especially over the last 2-3 years, just, saying that the dollar is going to collapse, it's going to crash, and they've been on the wrong side of this trade?
Yeah. First and foremost, whenever I'm here in Asia, so whenever I'm in Hong Kong, we'll talk about how fantastic China is. But all those people, this is anecdotal, all those people in China are telling me how fantastic the US is, despite what everyone says. It seems like the grass is always greener, and this is very anecdotal, but I can definitely tell you is whenever I'm in Asia, people are like, hey, this is nothing compared to what they have in the United States. And despite what anyone says, the United States is still the best economy in the world, despite whatever growth rates or artificial growth rates you hear in China. So when I started to hear that, then I started to think about like the portfolio overall. And then I started to take a look at what's happening in the world. So let's look at a calendar for a second. Let's start on October 31st, 2014, which is the last day that you start to see the end of basically the 6 years of quantitative easing in the United States. On that very day, the BOJ comes in and says, look, we're going to expand with a new massive QE scheme. Okay, on that very same day. Then 3 weeks later, ECB comes out and says, look, we're going to do whatever we can to make sure that there's significant inflation because there's a deflationary commodity environment. And we're going to purchase whatever it takes in terms of euro government bonds. Okay. And on that same day, China comes out and says, okay, we're going to cut interest rates. And it's been the first time that that's happened in like 2 years. And then a few weeks later, a smaller currency, the Swiss National Bank just comes out and says, look, we're going to basically become a derivative of the euro, and we're going to do everything to make sure that our price is wherever we want it to be to replicate whatever's happening with the euro currency. And the funny thing and the scary thing is actually what you've noticed, Frank, is that central banks are almost, which typically were known to be, lenders of last resort and regulators, have actually become hedge funds in themselves, which is the scary thing. And if you understand that all these currencies are actually trying to deflate, while the US dollar potentially has the possibility of increasing interest rates next year, is the best currency in the block. And when you understand that QE is going to continue worldwide, like I mentioned to you earlier, there's about $2 trillion that is going to be injected into the global economy next year. That actually gives us the average of the last 6 years. The last 6 years has been about 13 trillion injected into the global economy. Next year, you're looking at about 2 trillion. So you're actually staying on averages. Nothing has changed despite the fact that the U.S. economy is doing well and is actually thinking towards increasing interest rates. And the regulators have actually said, look, we're going to regulate the Wall Street banks and try to minimize your trading in terms of commodities so that you can boost the value of your financial assets, whereas the hard assets, like commodities, are actually going to experience a pullback. So what's happening, the reason why the US dollar is doing so well, and why you're starting to see, I don't know where the unintended consequence is coming from. Is it the commodities that are doing terrible is affecting the US dollar, or vice versa? But definitely there is unintended consequences about what's going on, where all of the currencies are going down. QE is resuming through other central banks of the world, and the S&P 500, because they have multinationals, a big basket of multinationals that are able to generate revenue the world over, are going to be the major two benefactors. So S&P 500, US dollar. Not as plain vanilla if you understand all the dynamics that are happening. And then analyzing price, continuous confirmation that you're making higher highs on both the S&P 500 and the US dollar is the conclusion to the thesis.
Well, Peter, I could probably talk to you for another hour because I love picking your mind. It's cool. So hopefully this is translating okay to my audience, because a lot of fascinating stuff here. Things that you said about technical analysis, things you said about Warren Buffett, what you're doing, what you're investing in your portfolio. I just think it was really cool to have a hedge fund guy come on here. And there's so many exotic investments out there. And you're just like, no, these are the two things based on my analysis that work. And sometimes, that stuff. And again, I use the word simple, not saying that, you're not doing the research and the homework behind it, but using a strategy like that where you're getting trading alerts from newsletters 7 times a day, and you're factoring all those costs, easily outperforming the market with that strategy. But, and we're out of time here. I just want to say a couple of things here. One is, again, the name of your book, which I think is great, is The Big Trade, Simple Strategies for Maximum Market Returns. But the last thing I want to end with here is your podcast, which is cool. So if you like Peter, you just started up a new podcast. Why don't you talk about it a little bit?
Yeah, it's I do this for the love of the game, Frank. As you see, I'm more interested sometimes even talking about it. And what I wanted to do was just bring together like really interesting people that I know or wanted to reach out to talk to. So, for example, one of the current projects I'm working on for the podcast, it's called The Big Trade Show, by the way. You can get it on iTunes or on SoundCloud or on Stitcher, is I'm actually looking into the Medici family in Italy. And they were basically the financiers to the whole Italian Renaissance that happened, which also led to the whole Age of Enlightenment. And I'm actually trying to reach out to professors to try to talk to them about how this banking family was able to finance the Pope or various different popes, help Michelangelo, Galileo, Leonardo with all their arts. And think about the connection between finance and culture from that perspective. So the purpose of the show is actually just to bring together like thought leaders and very interesting people that I wanted to talk to and just, provide that to the audience as they gradually get to understand this approach to analysis and investing that hopefully will make them do significantly better than what they've been reading or seeing before. Because like you said, there's a whole bunch of newsletters and there's so much noise, right? Especially through this whole information revolution, is people are being bombarded by too much information. And if you're looking for, we talked about it again, the 80-20 rule is that if you're just looking for the maximum results that you can get with minimizing all that clutter and that noise, then maybe what you want to do is just take a look at the numbers, the hard facts, right? Be as pragmatic to everything as possible. So the show is called The Big Trade Show, very similar to the book. You can subscribe that on iTunes. You can read the book to learn more about the approach and the strategy and start programming your own approach using a simple Excel spreadsheet. And if you're just interested to hear more about what I'm doing at my company called Phoenix Capital, we're an asset management company. You can go to phx-cap.com to read more about Phoenix Capital. So I'll be spending more time in the U.S., Frank. Just like we talked about what Warren Buffett is doing, we're actually looking at that very same approach and strategy and seeing what we can incubate as well.
No, that's great stuff. When you go to the U.S., I'm sure we'll catch up and we'll meet face to face. I just want to thank you for coming on. Again, that podcast, guys, is absolutely for free. And, you gave out your book and everything like that. But I was just fascinated to talk to you. I thought you'd make a great guest on my show. So I really, really appreciate you taking the time coming on.
Take care.
Hey guys, let me know what you thought, Peter Pham. I just thought he would make a good guest. Maybe the interview is more about me than about you this time. But, and I don't mean that. I just think that, of course it's a little technical, but his strategies were pretty cool. I like that he called out technical analysis because it's controversial. Not necessarily that I agree with him. I'm a fundamental guy, but I think there's definitely use for technical analysis. I think Peter believes that too, but he was just saying, how, he breaks down his simple strategies in his book, to show, technical analysis, isn't what it used to be. Again, the time it translates into you and everybody using these strategies. I mean, I can honestly say when you're writing a newsletter, if you have a huge following, 10, 20, 30,000 subscribers or more, and you're trying to write about trading strategies and getting in and out of these positions, it's a lot easier to do for yourself than if you're the editor of a newsletter talking to 30,000 people, because they're all going to follow that same strategy. This is something Peter was passing down. By the time it gets to you, and everybody else, things are going to look a lot different. So if you're going to buy something and you see something, tech analysis, and you're like, wow, this stock right now, I'm going to buy it at $30.50. The time you write that alert and get out to 30,000 people, where do you think the stock's going to trade the time it hits? It's going to be $33, $34. It may not apply. So, just keep that in mind if you're subscribing to technical newsletters, because it's not as easy to do as a fundamental newsletter or what I do. That's why I respect a lot of those technical guys, where I could say, listen, here's a 12 to 18 month period. Here's the catalyst. Here's the valuation. This is where I believe the stock's going to be 18 months from now. And yeah, it may run up because I have a lot of subscribers. It's going to come down, probably, the trading opportunity. just keep that in mind. But I thought that was fascinating stuff by Peter. Let me know what you thought. Curzio1@gmail.com. I wanted to bring in a hedge fund manager. It's a different approach. I mean, today we look at hedge fund managers. Back in the day, like 10 years ago even, everything was secretive when it came to hedge fund managers. Like today you have, Einhorn, Ackman, Icon on TV. Icon was on, this week talking about Manitowoc. I mean, these guys take huge positions and then use TV as an outlet to tell everybody, oh, we're in this position. It should be higher, an active investor. And, which is great for them because, whatever, they get the stock up. Look what Ackman's doing to Herbalife, just saying it's going to be fraud. And, everything that I researched on Herbalife is fraud. And I'm going to give you this presentation tomorrow. I mean, it's borderline. And I'm a huge fan of Ackman. I mean, ethically, throw it out the window, but I don't even know if that's legal. I guess it is. But it's a lot different in the hedge fund management industry because they used to be so secretive. You didn't know their strategies. And today you know a lot of their strategies, but it's always after the fact. And I want you to keep that in mind. When these guys are investing and you see, they come out of what Icon's going to investing every quarter or, Einhorn, those guys are in the position 2-3 months ago. So just be aware that those stocks could be a lot higher, by the time you hear about it. So I just wanted to go behind the scenes a little bit. It might have been too technical. Please email me. Let me know what you thought. Curzio1@gmail.com. I like the interview. Again, it's not about me. It's about you. I'm a big fan of Peter and his podcast, which is absolutely free if you want more information. He provided it. But let me know what you thought. Okay, guys. Happy New Year. Be safe. A lot of crazy people on the streets. Enjoy the holiday. I'll be writing my first newsletter at Weiss. I'm writing it this weekend, so it should be published by next week, maybe the week after. We'll see. I think it's going to be published first week. We'll be sure to email all of you once this happens. Thanks so much for all the support. I mean, it means so much. All the emails that I got. That's why I love doing these podcasts. Hope I'm able to help you as much as you help me through all your emails. So continue to send me those emails at Curzio1@gmail. And last note here, which I think is a wonderful thing on CNBC. It was on Tuesday. Archaic ringing the bell. It was one of the first times ever that I had someone ringing the bell on an anniversary. But it's a 50-year anniversary. He actually signed the original book with Rockefeller is in that book. I mean, J.P. Morgan's in that book. The original New York Stock Exchange book. So he's been there for 50 years. And one thing that was amazing to me is Bob Asani was not emailing, but he's interviewing him on the exchange and congratulating and saying how great he was. And as he was interviewing him, Archaic was looking up in the air to see where the markets opened. I just thought that was fantastic. I mean, it's in his blood. He loves it. He loves stocks. He loves trading. I mean, this is a moment about him. His whole family's there, and he's just looking out to see when the market's open. As he's getting interviewed, it just wasn't about him. It was so cool. It was so cool. So I really like that moment. 50 years on New York Stock Exchange. Congratulations, Cash. I wanted to end with that. I will see you in 7 days. No, I wasn't going to say I will see you next year. Don't worry, but I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.